for the topic tonight. This topic is not very often understood and explained by entrepreneurs. And to my knowledge, I'm the only one that teaches it this thoroughly. So we're going to go through it tonight real quickly in the time we have remaining. And it's actually is quite unique to get this type of information. Understanding preferred stock turns out to be a very vital aspect to understanding how to do scalable entrepreneurship. And I'll tell you about that in just a moment, how that fits. So first of all, let's look at a continuum here on what type of entrepreneur you or an entrepreneur group might be. So if we have this continuum, we have on one side risk-averse and debt-averse entrepreneurs. And then we have equity conservationists on the other end of this continuum. Risk-averse or debt-averse entrepreneurs versus equity conservationists, and entrepreneur will fall anywhere along this continuum. And it's important to know who you are and what you are. So for instance, a risk-averse and debt-averse entrepreneur is somebody who will accept dilution over taking on debt. They're worried about paying back the debt, they're a little scared of debt, and they want the investor to be at co-risk with them. An equity conservationist entrepreneur, in contrast, wants to avoid selling equity cheap early on in the venture. They also are showing a very high commitment level, and they're trying to conserve wealth for the founders and the early employees. So in looking at this, we can then look at the different mechanisms of investment, equity versus debt, and look along a similar continuum, equity and debt, equity on one side, debt on one side, and this matches up well with the previous continuum. So if you're risk averse or debt averse and want to sell equity, what are the types of equity? If you are okay on taking on debt, what are the types of debt instruments? Well, it turns out, as we look at this, that common stock and preferred stock are the two types of pure equity that you can sell in a venture in order to raise capital. So common stock is very easy to understand. How many shares there are in a company, how many shares you own that percentage of the company. Preferred stock is a tricky piece of equity, and it's used extensively in the venture world by venture investors, and it's very important that entrepreneurs understand the implications of preferred stock, and so that's what we're going to talk about tonight. Just finishing out this though, we have convertible equity or SAFEs. We also have a keep it simple security called KISS that has equity versions, debt versions. We have convertible debt, of another very popular mode of investment in ventures. And then we can go over to venture debt with warrants, revenue-based lending, and straight debt. We talk about a lot of these concepts I'm talking about tonight extensively in the curriculum of Startup Ignition, but tonight we're going to just go over real, as briefly as we can, preferred stock. So first of all, when we're looking at investments and in different rounds, this is a cap table taking us through the different rounds of investments, starting with the founders round, going to the friends and family round, the angel round, the seed round, the VC round, and ultimately an IPO if a company were to go that far. So in looking at this, the types of instruments used in investment, usually in the founders round, that's all common stock that the founders get. Then in family and friends round, it's usually common stock, but possibly could be convertible debt. And then in angel round, we're looking at common stock, convertible debt, and maybe some sophisticated angels might ask for preferred stock. And then as we go into institutional investors from seed, venture funds, and VCs, we're looking at preferred stock and almost exclusively. So what is this about preferred stock? Why is it important, and what's the implications? Well, first of all, let me tell you that when we go back to IPO, we get rid of all preferred stock and go back to common. So with that said, let's go through preferred stock and explain what it is. So a quick note, one of the most prolific startup entrepreneurs in Utah is Paul Allen, the founder of Ancestry. He said about preferred stock, the single most important lesson he learned the hard way was the day he learned the difference between preferred stock and common stock. So this is an important lesson. Let's take a look at it. First of all, preferred stock is governed by a preferred stock purchase agreement that the investor and the company being invested in will sign. Gets its name because the preferred stock has preferences over common stock. So preferred stockholders have preferences or preferred treatment over common stockholders. Now, what does this mean? Well, there's a set of preferences, probably about 60 of them, that are in these documents when you sign them. I'm going to only go over about the top 5 or 6, even though there are 40 to 60 usually in any set of preferred stock documents. By far, the most important preference is called the liquidation preference. The liquidation preference is when the company has an exit and liquidates its stock, either for good reasons because somebody's buying it or is liquidating it because it's going out of business. The liquidation preference says that the preferred shareholders get their money back first before common shareholders. So that means the preferred investor would get all his money back before $1 would go to any common shareholder, such as the founders. And this is usually expressed as a 1x, 2x, 3x, ... In other words, do they get 1 times their money back before anybody gets money, before any common gets money? Do they get 2 times back or 3 times back? That's called a liquidation preference. When somebody asks how much preference do you have in your company, they're asking how much liquidation preference have you placed on this company by the deals you've done before any common shareholder will get 1 penny. That's called a liquidation preference. Now, this applies to dollars and not shares. So if you bought so many shares, that doesn't matter. It's how much dollars the investor puts in is what they have a right to get out before any common shareholder. Now, the next most important one that works in an interesting way with the liquidation preference is called the conversion preference. And these conversion rights are also expressed as a 1x, 2x, maybe all the way up to 10x. And this is saying when the preferred stock converts to common stock at a certain trigger, how many shares are created of common. If you had a 1x, that means for every preferred share, it would just convert to 1 common share. But if you had a 2x or 3x, that 1 preferred share would convert to 2 or 3 common shares. This has profound implications, especially when working with liquidation preference. Now, when we say what type of preferred stock we have, there are 2 genres. One is called participating preferred, and the other is called non-participating preferred. This is important to understand. Participating preferred shares are those where they get to participate in the liquidation preference and the conversion preference after the liquidation preference has been taken care of. Non-participating preferred says that the investor only gets the higher dollar gain of either of these, not both of them. So they would either take their liquidation preference or their conversion rights preference. That's non-participating preferred. So it's important to understand that there can be participating and non-participating. To be honest with you, about 98% of all preferred stock given to startups and early stage companies is participating preferred. Very few companies are able to negotiate out and get non-participating preferred stock. As an entrepreneur, you would want non-participating preferred so that there's not the double dipping that occurs, and you'll see that in just a minute. Going on, a third preference is board seats. Preferred shareholders get board seats, and this is going to be an important negotiation. The preferred stockholder or investor is going to want a 2-2-1 board, where 2 would be voted in by common shareholders, 2 voted in by preferred shareholders, and 1 voted in by those 4 board members as a 5th neutral board member. You as an entrepreneur are going to fight to keep it to be a 3-2 board. For instance, 3 voted in by common, 2 voted in by preferred. This is important. If you relent and give up this negotiation item and go with a 2-2-1 board, you've now lost control of your company, and you could literally be fired from your company after going this route. So most entrepreneurs should fight to keep a 3-2 board. Sometimes you can't do that because you need the money and you want to do the deal, but it's important to understand what's going on. The next one is a set of 2 preferences called first right of refusal and preemptive rights. First right of refusal is saying that preferred shareholders have a right to buy any existing shares before anyone else. So if an existing shareholder goes and finds a buyer for $2 a share for stock, The existing preferred shareholders, instead of that existing shareholder selling it to another outsider, the preferred shareholders can swoop in and do the deal at $2. Preemptive rights is similar, except it's when the company goes to sell new shares and the company would want to sell to a new shareholder that's previously not been in the company. The existing preferred shareholders can preempt that sale and do the deal themselves. This is how they accumulate more stock in the company. The fifth one to talk about is called protective provisions. This is about a 4-page, even when the print is small, in a preferred stock purchase agreement of one paragraph with about 20 different preferences in that one paragraph. And these are preferences like the management team may not give themselves a raise greater than 3% in any 1 year. The management team may not encumber the company with greater than $10,000 of debt with the approval of a majority of the preferred shareholders. The company cannot write a check for greater than $5,000 without the approval of the preferred shareholders. Different provisions like that, and there's about 20 that will be in that one paragraph, and you have to read each one of those. Now, there are many more we could talk about. Like I said, there's probably 40 to 60 in an average preferred stock agreement. Now, these have big implications, just these top ones, and so let me run you through some examples. First of all, let's take a company, ABC Incorporated. The founders founded it with 4 million shares of common, and then they sold to an investor, let's say a seed fund, 1 million preferred shares at 50 cents a share to raise $500,000. The total outstanding shares in the company now are 5 million shares, with the 4 million common and the 1 million preferred. So what percentage did we sell the investors? Well, we sold 1 million shares and there's now 5 million, so it looks like the investor owns 20%. Let's see how this plays out. So let's take sample number 1. Let's do a liquidation preference of 1x and a conversion preference of 1x from our earlier discussion. If we, let's say, a year after taking in this investment, we get an acquisition offer and we do a quick early sale of the company for $5 million. Well, how much goes to the preferred shareholders for liquidation preference? Well, the preferred shareholders put in $500,000, so they would get the first $500,000 of the 5 million off the top. That would leave how much to divide between common shareholders? Well, that would leave 4.5 million. Hopefully you're following with me. If any of you are getting lost, go ahead and put a message in the chat saying you need me to go back to something. Now, how do we divide up this $4.5 million between the common shareholders? Well, first of all, we have 4 million common shareholders from the founders, and then the preferred shareholders, after they got their $500,000, since it's participating preferred, are going to get 1 million shares of common from their preferred shares. So there's another million common being created at that moment in time. So how many common shares are there now? 5 million. So we're going to share $4.5 million, okay, amongst these common shareholders. So what percentage is owned by each? Well, the preferred shareholders own 20% of the common now, and the common shareholders own 80%. So that 4.5 million is going to be split this way. The preferred shareholders, after they've gotten their first 500,000, would get 900,000, and the common shareholders will get 3.6 million. This means, what was the total final outcome? Well, the preferred shareholders got their $500,000 plus the 900,000 for 28% of the exit value. The common shareholders got 72%. But we thought we sold the investor 20%. But in this scenario, it played out to where they got 28%. Now, this can have big implications. If you're ever having to be more desperate to raise money, you might be pressed to change some of these preferences more in favor of the investor. The good news is this does not happen much in very pro-entrepreneurship times, but in times where we're dipping and it's harder to raise money, it can happen. And if you run out of money and don't have much time before you're going to have to meet payroll and other needs, you can really pay the piper. So let's take a second sample. Let's take a sample where the liquidation preference is 2x and the conversion preference is 3x. And I have seen deals like this. Let's take a look at what happens. That same acquisition at 5 million looks like this. How much preference for liquidation preference? Well, $1 million. They get 2 times their $500,000 they put in. That leaves $4 million to be divided by common. So how did we divide it up? Well, there's 4 million common shareholders, and then there are 1 million preferred shares coming from the common. Okay, but those preferred shares become 3 million common. So now there are 7 million total common shares to divide up the $4 million. How much is owned by each? Well, it turns out that if we look at this, the preferred shareholders have 43% of the common and the commons have 57%. How much common dollars total are there? Well, the preferred shareholders get 1.715, the common shareholders get 2.285, and the total outcome is the preferred shareholders got their first million plus the 1.715, or 54% of the exit value, and the common got 2.285 million, or 46%, and we thought we sold them 20%. Now the question comes up, would venture investors really do this? The answer is yes, they would do this. Matter of fact, they have to do this. This is what their job is to make as much money for their limited partners as possible, and they would never let you out of your commitments under these terms. So this is how it works in the venture world. So understanding preferred stock ends up being very important for growing ventures that take in institutional investment in the form of preferred stock. Now, are there any questions about preferred stock that you might have? I'll open it up for 30 seconds if you'd like to ask a question or not. If not, I'll just close with a couple more comments.
So I have a question.
Yeah, go ahead, Sebastian.
So is there a coupon that is paid on that preferred stock on a regular basis, or is it all happening at the exit?
No, they don't pay a coupon, but it can accrue interest at a common thing like 4, 6, or 8%. So the 500,000 could, after 1 year, if it were at 8%, for instance, be $540,000.
Got it.
Okay, that can happen too. Good question. Any other questions? All right. If there's no other questions, I'll just close by saying you're invited to apply for Startup Ignition for November 11th, 13th. Go to startupignition.com. There's a banner at the top where you can click. And by applying, there's no commitment. You just have an interview with me, and we talk about what you're working on and see if it's a good fit. So that's one thing to do. Remember, we have discounts for a lot of other folks. So I want to thank you for being with me tonight. I'm sorry we got a late start, but at the same time, I hope you enjoyed this lesson and something that's not too often talked about. Thanks again for your time, and thanks for being on with me tonight. Bye-bye.
Thank you.